What if you wanted to pay less money to the government and to Uncle Sam? Today, we're going to be looking at tax sheltered accounts, which are very accessible wealth building tools for everyday investors. It is the evolution of Americans are not saving enough money, not saving enough for retirement, and having these tax sheltered accounts will make a big difference. Now, the evolution of savings has come from just putting it in a bank and really putting it under your mattress, saving it all, to making smart decisions, maximizing your taxes, and also your investment accounts to maximize when it comes to retirement and really building up that retirement fund. Now, it has been 150 years since American Express created what is regarded as the first retirement savings vehicle, which was a pension plan for disabled workers, which caught fire 150 years later. Most of us are seeing these tax advantage accounts and really requiring them to boost our retirement returns, but also the funds when we get into the retirement age. So in today's video, we're going to be breaking down 5 of those accounts, starting with our first one, the traditional IRA, or the traditional individual retirement account. Now, this is a tax deferred account. This is the traditional variation, which means this is a tax deferred growth account. You put money into that, your contributions into there are tax deductible, which is going to lower your tax burden in the year you make the contributions. Now, the money in there grows tax-free until you take the money out, which at retirement, at that point, it is ordinary income. It is taxable income. So the reason why the traditional IRA is so attractive is if you're a high income earner, let's say you're earning $100,000, you contribute $10,000 into the IRA. That means you're only getting taxed on the $90,000 that is left. Now, I know the contribution limit, I believe, is $7,000 now, $8,000 if you do a little bit of a catch up, but you can kind of see how the nice round numbers mathematically make out. Now, of course, when you put the money in there, you can be penalized for early withdrawals under 59 and a half, which not only do you have to pay taxes on the money you take out, there could also be a 10% penalty for the tax if you don't have a qualifying reason. So the traditional IRA is honestly, for me personally, being a financial counselor, this is the most common really retirement account that I see. I see 401ks, I see traditional IRAs. That is what a majority of people are putting their money into. Now, there are a few caveats that I want to cover with this. With an IRA account, whether it is traditional or it is the Roth variation, I would not, and I do not recommend keeping it at financial institutions because the rates are much lower. When it comes to retirement accounts in general, they need to be invested in the market. I cannot stress that enough. When you start putting it into CDs, you're getting 3.5%, you're getting 4%. It's not growing fast enough to edge out inflation. You're not seeing enough growth in your portfolio over an extended amount of time to really make it worth it to keep it in those financial institutions. It needs to be invested in the market. And if you want to open up an IRA account, I have a link right down below to M1 Finance. Definitely check it out and let me know in the comments what you guys think. Now, the second variation of this individual retirement account is the Roth variation. Now, this is the one that I always push members to, that I always think is the best investment vehicle. Now, the difference between the traditional and the Roth is the tax treatment in the year you make the contributions, and also the tax treatment when you take money out of there. For the Roth IRA, tax-free growth, tax-free withdrawals during retirement. So with the Roth variation, you make after-tax contributions, which means, again, just nice round numbers. You put $10,000 in there, you pay, guess what? Whatever you have left, whatever you earn that year. So again, if you earned $100,000 that year, you put $10,000 into a Roth, you are still paying tax on that $100,000 that you have. But the big caveat to this is when you start taking money out of here, it is tax-free. You're paying either your taxes up front with the Roth method, or you're paying the taxes down the line with the traditional method, which when you take in the growth factor, that's the biggest thing where I feel like people have the hurdle. When you think of contributions into a traditional account and the contributions into a Roth account, the Roth is already paid. And then when it starts growing, the taxes on that are already paid. And of course, when you start getting much older, once you start getting into retirement, you don't have to take required minimum distributions out of that Roth account. Now, that is not true with the traditional. They are going to require you at some point in time during retirement to take money out of that account, meaning you're going to be paying taxes, could put you in a higher bracket, and could essentially take up and eat up a lot of those retirement funds you have in there. Now, of course, contributions but not earnings can be withdrawn anytime without penalties. Earnings can be withdrawn tax-free after 59 and a half. So two very similar ones. But with the Roth variation, you also have to have that account open for at least 5 years. They are two really big ones. Again, out of those two, I really do recommend that Roth variation, paying your taxes now instead of just kicking that tax can down the road, knowing that you're going to have to pay it later. Now, the third one we look at is 401k plans. Now, for the 401k plans, this is the most popular vehicle when it comes to investment. It is the employer staple. Now, with 401k contributions, it is a much higher, and salary goes in there, usually is pre-taxed, reducing the taxable income. Unless you're like me, I have a Roth 401k. So that is if your employer offers it, I would definitely, again, very similar to our traditional and our Roth options for the IRA, I would go ahead and do a Roth 401k plan, knowing that it's invested. Now, this has a cap of $23,000 per year, $7,500 catch up, and we know this increase every single year, meaning with those 401k plans, they are invested plans. You can go ahead and make your contributions on regular payroll contributions. And of course, the perfect storm with this, or the perfect really candidate, is if you have an employer match. Majority of employers match, and I believe the average is around 5%. So you put in 5%, they put in 5%. You double your money, you instantly get a 100% return. Prioritizing these contributions is really huge when it comes to building this up, and when you know that the plan is going to be there in making regular contributions into those 401k plans. Now, the fourth one we look at is the HSA account. The health savings account is a tax advantage account, which gives you a triple, that is right, 3 times tax advantage, and it is the only one that has a triple tax advantage. So what do we mean by that? When you make contributions, they are tax deductible. That is number one. When you see growth in there, the money will grow completely tax-free. That is number two. As long as you make withdrawals for qualified medical expenses. Number three, it is completely tax-free. So if I put $10,000 in an HSA, which I know that's over the contribution limits, but I put $10,000 in there, let's say it grows to $12,000, then I spend that $12,000 in medical expenses. I got an upfront tax advantage. I grew my tax-free money in there. And then with the qualified medical expenses, it was completely tax-free as well, giving it that triple tax advantage. Now, it is estimated when you're in retirement age, so 65 plus, when you get into retirement, they estimate about $74,000 in medical expenses. And I know that's kind of astronomical, but if you have an HSA, let's say for 10, 20, 30 years, getting those contributions and maxing out those contributions, getting as much really that you can into this account can even cover, the first few years or the first couple decades when you're in retirement with the funds you have in this HSA account. Then, of course, if you get it to the point where it's growing faster than what you're actually taking out of it, and really getting that snowball method within the HSA account, getting some solid, decent growth out of there while you're using some of the money makes a massive difference if you don't have to use those retirement dollars. So looking at your IRA funds, your 401k funds, even looking at your Social Security to cover medical expenses, you are going to be well off for an individual during retirement. HSA accounts, I feel like, are really big and overlooked. And the last one we look at, number 5, is the 529 plans, or the college savings plans. For me, this is the MESP program that I have for my kids. Now, they have changed the way the MESP program has worked, and they let you actually convert, if the money is not used for higher education, into a Roth for that individual, up to, I believe it is now $30,000 with the change. But when you start looking tax advantage savings, that is dedicated to education. If you have kids, if you're using it for yourself, you can make contributions into this college savings plan. You can use it for qualified education expenses, including tuition, books, and room and board. So if you are paying for a college education, this is the way to do it. Now, this does have a $300,000 lifetime cap in it. It says it varies by state. I'm not sure exactly what your state is. While your contributions are not deductible on federal, you do get it on state. And then, of course, when the money comes out for qualified educational expenses, very similar to what we see with the HSAs, it is completely tax-free, which again, when you think of your parents, your grandparents, guardians that want to kind of prepay for a child's education, the 529 is a perfect vehicle. So how exactly do we break this down and what do I recommend? My really order of operations, my financial order of operations. Number one, the 401k plan. This is the point where you're going to put in at least the very bare minimum when it comes to the matching. So again, if your company offers a 5% match, you meet that 5% match. That is number one that you're going to do in there, that you're going to put into this 401k plan. That is going to be the basis. Again, if they give you 7%, 10%, whatever it is, getting the match and getting that match 100%. The second one that I would do is HSA contributions up to what your deductible is. So if you have a $2,000 deductible, putting at least that $2,000 into that HSA account. And again, this is kind of the basis when you're starting out, kind of the order of operations. Third one I'd look at is definitely putting in the Roth IRA. Now, the caveat between this is between the 401k plan and the Roth IRA, the big variance between here is going to be what investments are available in your 401k plan and where do you want to put and what do you want to invest that Roth money in. If your company offers a Roth 401k plan that has a really good lineup of ETFs that you can put your money in at a very low cost, it might be beneficial just to put it in the 401k plan because it does have a much higher limit that you can make contributions to. And of course, when you start seeing the snowballing, if it is in a really good portfolio, it will make a big difference when it comes to growth. If your 401k doesn't offer a good lineup of ETFs or stocks and bonds, I would go ahead and do the Roth IRA variation, making sure that you're capping that out every single year, invested in the market like we talked about, and not just sitting there in a traditional or a Roth IRA at a financial institution. And the final one I would look at would be my 529 plan. If you have kids at this point, being the guardian, really the grandparents, parents, whatever it is to prepay for education, because we know the cost of education is only going to go up in the future. But that is the exact order that I have followed, and it has done incredibly well when it comes to the contribution. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.